No one likes getting a letter from the IRS saying that a tax return is being audited. An audit is the IRS reviewing a person's or business's books, accounts, and financial records to confirm that the tax return was filed correctly. Many audits are triggered by mismatches, unusual deductions, or reporting patterns that do not line up with what the IRS expects to see. Here are 10 common reasons a tax return could get audited. 1. Not reporting all income. The IRS receives copies of many tax forms, including W-2s, 1099s, K-1s, and investment reporting form. If a return leaves out income that was reported to the IRS by an employer, client, broker, or bank, the mismatch can trigger an audit or other IRS notice. 2. Very high income. Higher income taxpayers are audited more often because the potential tax difference is larger. A sharp jump in income from one year to the next can also attract attention if the return looks inconsistent with prior filings. 3. Large deductions compared with income. The IRS looks for deductions that seem unusually high relative to income. Large charitable donations, business write-offs, rental losses, or itemized deductions can become red flags when they appear out of proportion and are not supported by records. 4. Home office deduction. The home office deduction is allowed, but it is closely reviewed. Claiming too much space, claiming personal space as business space, or lacking records that show exclusive and regular business use can increase audit risk. 5. Business vehicle deductions. Vehicle deductions are another area that receives attention because taxpayers sometimes mix personal and business use. Claiming unusually high mileage or 100% business use without a mileage log and supporting records can raise questions. 6. When a sole proprietor reports losses year after year, the IRS may ask whether the activity is really a business operated for profit or more of a hobby. Ongoing losses can lead the IRS to review income reporting, deductions, and whether the activity qualifies as a real business. 7. Cash-heavy businesses. Cash-intensive businesses, such as restaurants, salons, retail shops, and some gig-based work, often face more scrutiny because cash income is easier to underreport. If the revenue reported looks too low for the type of business, the IRS may take a closer look. 8. Large charitable donations or gambling losses. Large charitable contributions and gambling losses can be legitimate, but they often trigger questions when the amounts are high compared with income. These items usually require strong documentation, including receipts, acknowledgments, and accurate records. 9. Foreign accounts or assets not properly reported. Taxpayers with foreign bank accounts or offshore assets may have extra reporting requirements. Failing to report foreign accounts, foreign income, or related forms properly is a major red flag and can lead to serious penalties in addition to an audit. 10. Math errors, incomplete returns, or sloppy filing. Some audits or IRS notices begin with simple mistakes. Math errors, transposed numbers, missing forms, unsigned returns, and rounded or estimated figures can all make a return look unreliable and lead to more review. To sum it up, the best way to lower audit risk is to report all income, claim only legitimate deductions, and keep documentation that supports every major number on the return. If enjoyed this video, make sure to like, comment, subscribe, and turn on notifications so you do not miss out on my next videos.